I personally think we are right in maybe the biggest bubble of my career.
Once the Fed came in, people now expect the Fed's going to come in again.
The big challenge is raising interest rates enough without tipping the economy into a recession.
People's expectations, their views of the future inflation actually results in higher inflation. That's the problem.
When you have a Federal Reserve that one cycle after another, every time they have a crisis hit, they try and solve the problem of over-indebtedness by putting more debt into the economy.
You look at the central bank balance sheets exploding right now, and you say there's going to be inflation.
Stock market observers are sounding an alarm.
I personally think we are right in maybe the biggest bubble of my career.
Investors have loaded up on risky assets like housing, tech stocks, and even cryptocurrency.
Asset valuations are somewhat elevated. The cryptocurrencies that are really speculative assets, I do think they are risky. They're not backed by anything.
Many believe that the market problems started at the top U.S. bank, the Federal Reserve. The Fed controls all of the money in circulation. That includes all of the money in your wallet and the coffers at banks. They can print more during financial emergencies.
Once the Fed came in, people now expect the Fed's going to come in again.
For the last 2 decades, the U.S. Central Bank has kept interest rates on loans as cheap as possible. They also bought bonds, flooding the market with emergency cash. The balance of the Fed's bond portfolio has crescendoed to nearly $9 trillion, an all-time high.
What's happened is the balance sheet has become more of a tool of policy. The Federal Reserve is using its balance sheet to drive better outcomes.
The Fed's actions led the market to historic highs, but some within the central bank believe that this bond buying program needs to end. The sooner the better. Analysts project a $2 to $3 trillion wind down in the Fed's bond portfolio over coming years. Doing so would stabilize markets. But there's a risk. If the Fed drops its emergency stimulus too quickly, it could spark a recession.
The big challenge is raising interest rates enough, tightening policy enough to corral inflation without tipping the economy into a recession. Easier said than done. History is not necessarily on their side.
So how did the Fed acquire nearly $9 trillion worth of assets? And can they sell them without breaking the economy? The U.S. government relies on its central bank, the Federal Reserve, to manage the economy.
The Federal Reserve itself was created after a major crisis. There was a financial crisis in 1907. We didn't have a central bank, and there was a large study done that concluded that part of what we needed to avoid these future crises was a central bank that would be able to create more currency during times of stress.
The Federal Reserve has proven itself repeatedly over time well positioned to be the first responder in the face of any type of shock.
The Fed's most important tool is the federal funds interest rate.
The Fed funds rate right now is between 0.25%. That's as low as they can go.
It's highly unusual to have interest rates close to zero. Basically what the Fed does is it sets the rate at which banks borrow money between themselves overnight. Now from that short-term rate comes all the other rates that people pay for in terms of mortgage rates or home equity line of credit rates or automobile loan rates. But ultimately all rates are set by banks and by the market based off of that short-term overnight rate that the Federal Reserve sets.
Central banks around the world have kept interest rates low to stimulate further growth in the face of unusual financial conditions. In the US, bankers have resisted using negative interest rates. Instead, they've delivered economic stimulus with tools like the bond portfolio. They keep track of this spending with a balance sheet.
All banks have a balance sheet. They have assets and liabilities. The liabilities are the currency in circulation. They're called Federal Reserve notes. It's a primary liability. On the asset side of the balance sheet, then, the Federal Reserve has purchased a number of things, including government securities, some mortgages. It's all because you need to back those liabilities, that currency in circulation, with assets.
The Fed has the power to create more money when the financial system starts to break down. For this reason, experts call it the lender of last resort.
The lender of last resort was in many ways the original function of the Federal Reserve. We didn't want to have a central bank originally because we were worried about there being so much power aggregated in that way, but we needed this function, and so we might as well have it put in place in a way that allows oversight and accountability.
For much of its century-long existence, the Federal Reserve did not make much use of the balance sheet.
On 9/11, it was a balance sheet of roughly $750, $800 billion, and that was the largest it had ever been at that point.
Dr. Ferguson left the central bank shortly before the housing crash took hold in 2008. In that episode, nervous investors watching the real estate sector started to pull out of the entire market. To prevent the full-scale collapse of the financial system, Federal Reserve Chair Ben Bernanke authorized a large-scale purchase of bonds, sending the balance sheet rapidly upward. The pundits called it
quantitative easing.
Quantitative easing.
Quantitative easing.
Quantitative easing.
Quantitative easing was this mechanism of trying to spur more credit creation. And the core idea here was that by buying up safe instruments, treasuries, and agency mortgage-backed securities, they could spur even more accommodative credit conditions, try to get more economic activity.
Investors buy bonds to generate a modest but guaranteed return.
The U.S. Treasury bonds are perhaps the safest assets out there. They're known as a riskless asset. And most of the mortgages that the Federal Reserve is buying are what's called conforming mortgages, very, very deep and liquid market.
Many traditional investors recommend using a portfolio that balances these bonds against stocks. But when the Federal Reserve steps into the market, it's taking these safe bonds, making profits on them fall for everyone.
That is going to make it, from the investor perspective, more likely that they are ideally going to be putting their capital to work in ways that support private innovation.
Holding such a large balance sheet of nearly $9 trillion has contributed to this environment where a lot of money's flowing into risk assets, and you've started to see some crazy things. Companies that really don't have much of a business were able to go the IPO route in 2020 and especially in 2021 and raise a lot of money. Those businesses ultimately fail. There's going to be a lot of investors kind of left holding the bag.
Markets have come to rely on the Fed's purchasing patterns.
But by making the Federal Reserve so central in the efforts to get money to companies in the spring of 2020 and the summer of 2020, we did create an overall environment where we did far more to backstop some really fragile financial intermediaries. So if you were a large company, regardless of whether you were a highly creditworthy or a not so creditworthy large company, your ability to raise money by issuing new debt over the past couple of years has just been astounding.
The central bank took on non-traditional assets like securitized mortgage loans. To some, this has been controversial.
How many of you people want to pay for your neighbor's mortgage that has an extra bathroom and can't pay their bills? Raise their hand. How about we all? President Obama, are you listening?
The Federal Reserve warned markets that the time had come to wind the balance sheet down. That sent day traders into a panic.
In the next year or sooner, we are going to end quantitative easing. We are going to end bond buying. We are going to end the injection of new reserves that creates the necessary money supply. That ain't bullish for gold. I'm sorry.
The idea that one of the biggest buyers and biggest holders of government debt in particular and mortgage-backed debt would all of a sudden stop being a buyer and potentially start being a seller, that caused investors to freak out. And so they quickly backpedaled from that. And that never really even came to pass for, several years later. They started to slowly let bonds that were maturing roll off the balance sheet.
Over time, emotions calmed and the balance sheet plateaued. Ben Bernanke's plan had proved successful, and stock valuations were at a record high. The central bank started to unwind the balance sheet slowly before warning signs flashed again in 2019. Toward the end of the 2010s, strong market conditions gave the Fed enough confidence to start letting its bonds mature.
They didn't get very far before economic growth really slowed sharply, and they once again had to start cutting interest rates. And that was in the middle of 2019 when unemployment was at a 50-year low and nobody had ever heard of COVID.
The pandemic brought another significant round of bond buying. The Fed again took the safe treasury bonds and mortgage-backed securities off the market. They also set up lending facilities to buy bonds from municipalities and corporations.
That was a new thing that the Fed did this time around.
The 2020 bond purchasing program brought investors flooding back into the stock market after a sudden collapse.
Holding such a large balance sheet of nearly $9 trillion has contributed to this environment where a lot of money's flowing into risk assets, and you've started to see some crazy things. Things like cryptocurrency or even NFTs. I think a lot of the fervor for those has been driven by this ultra low rate environment where the pursuit for return meant going into risk assets.
The large cash injections boosted large corporations at the expense of smaller businesses.
The Fed just didn't have the right tools to really help out small businesses. And as we saw with the Main Street lending facility, which was supposed to help out mid-sized businesses, the Fed also didn't really have the right tools to support them. By contrast, the largest companies in our country are much more able to raise funds through mechanisms like issuing debt into public markets. And this has been bought up like crazy by these open-end bond funds and ETFs backed by bonds. And what we don't want is the complex set of machines that is the financial systems to grind to a halt because it lacks the liquidity. You don't want to force a recession as a result of a breakdown in the financial system.
Members of the Federal Reserve contend that these emergency asset purchases are necessary. They believe that the debts will be paid as they mature.
After almost every crisis, there's often a survey, often a commission done or hearing, et cetera, and then Congress decides how to adjust the authorities to help focus on these crises.
The resulting end of our pandemic asset purchases will remove another source of unneeded economic stimulus for the economy. I expect that these steps will contribute to an easing in inflation pressures in the coming months.
Certainly some of these people on the committee are hot to begin reducing this balance sheet.
The Fed plans to unwind its asset portfolio at a more aggressive pace than what it attempted following the housing crash.
We may find for all of us that the price of money, cost of a loan, the interest rate gradually starts to rise from what has been historically very low levels. I've already seen some of that. Mortgage rates are a little bit higher now than they have been in the past, and also the borrowing rates for corporations are somewhat higher.
The Fed will shrink its bond portfolio by $2 to $3 trillion in this round. Market turbulence could follow the Fed's tightening of the economy, sparking a recession.
Are we going to go back to the Fed having a balance sheet of the size that it was in 2006 and early 2007? There I'm far more skeptical. The role of reserves on bank balance sheets has changed a lot.
It's not fair to say the balance sheet is not supposed to be used the way it's used. It is a new tool. What's new about it is, one, it's being used quite consistently. Two, it's being used at a scale that was not imagined before. But it is very public, but like lots of things in plain sight, you don't necessarily notice it.
Prices for just about everything are rising fast. In October 2021, inflation took its biggest jump in more than 30 years. It's hitting specific parts of the economy hardest. Drivers face a 59% increase at the pump compared to 1 year ago. The average used vehicle is selling for 26% more than it was a year ago. Vacation homes are renting out at a premium too.
Nobody likes inflation. Nobody wants to pay higher prices for anything, really.
Maintaining stable prices is one of the Federal Reserve's main responsibilities. In recent decades, the economy has hummed below the central bank's target rate.
Now, post-pandemic, the Fed, they want inflation, at least for a while, to be above 2%. And they'll get exactly what they want simply because of the acceleration in rent growth.
Critics say there are signs of turmoil in the economy that the Fed isn't hearing.
I think it's pretty darn clear that the Fed cannot control inflation on the downside or the upside, given the current experience.
The central bank has its defenders too.
The weight of the evidence is finally going Powell's way. Team Transitory is going to win.
There's a lot of reasons to think that inflation is transitory. It doesn't mean it's going to be 2 months. It could be a year, but it's not going to be 4 or 5% a year for the next 5 years.
In the backdrop, governments are spending big to keep society afloat. The U.S. Treasury's debt is managed by the Fed. The bank's assets swelled as it printed trillions of dollars to backstop the country. Which leads to the question, can the Federal Reserve control inflation? And if so, what could it do to rein in the cost of living in the United States? The people who manage the U.S. economy prefer to keep inflation around 2%. That's because a low and steady rate produces a healthy business environment. These rates are tracked in categories like food, energy, and housing. These components are then weighted against one another to establish their importance. The final scores that are produced are then recorded over time. The primary one you hear about on the news is called the Consumer Price Index. It tracks all of the spending from 93% of the US population. Then there's the trimmed mean inflation, which throws out outlier data and focuses on core prices. Movements in the trimmed mean signal a more potent inflationary trend. Then there's the PCE.
The Fed really prefers to look at PCE, that is Personal Consumption Expenditures Price Index.
The Fed's preferred measure of inflation is broader than the trimmed mean, but it throws out some data from the energy and food sectors. That's because prices take bigger swings in these industries more frequently. What's included and what's excluded from each inflation index impacts its reliability. Some, like Danielle DiMartino Booth, a former Dallas Fed employee, believe that the PCE is flawed.
My biggest issue with the PCE is that for your average American household, you spend between 40 and 50% of your income on housing. If you look at it through that simple of a prism and understand that the PCE's input for housing is only around 22%, then you see that you're undercounting households' biggest expense by a wide margin.
In the fall of 2021, the PCE numbers spiked to generational highs. When events like that happen, public officials turn to the Fed for answers. The Federal Reserve was originally set up to create a stable American banking system. Its role has expanded over its century-long existence. In 1977, Congress gave it a dual mandate.
Part of that mandate is to maximize employment. The other part of that mandate is to stabilize prices or to basically keep inflation in check.
Wilson says that the Fed's ability to manage inflation depends on the extent to which inflation is driven by the labor market.
We're currently seeing inflationary pressures largely because people have shifted their consumption from purchase of services to purchase of goods. That has caused demand for goods to outpace the supply of goods in a period of time that suppliers did not have adequate time to really respond to that increased demand.
In 2021, a sputtering global supply chain and backed up ports are causing delays. Many people, including the leaders of the Fed, don't believe the economy has settled. Chair Powell previously said this bout of inflation is transitory, but now he's walking back from using that language.
We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
The central bank believes current conditions don't change the long-term outlook. That's because in recent years, inflation has actually been lower than what the Fed wanted.
Pre-pandemic, inflation was soft. The Federal Reserve had a 2% inflation target. It was below 2%. Now, post-pandemic, the Fed has been saying they changed their thinking here. They want inflation, at least for a while, to be above 2%. And they'll get exactly what they want simply because of the acceleration in rent growth.
In 2019, newly elected Chair Powell argued that long-term expectations of inflation were low. Experts observing the labor market reported that the interest rate liftoff that began in 2019 cut the recovery short. Then, an unexpected event, the pandemic, pushed the central bank to create
accommodative financial conditions.
That means dropping interest rates, which in theory will make prices rise more quickly.
Nobody likes inflation. Nobody wants to pay higher prices for anything, really.
Economists believe that expectations are the primary driver of inflation.
Well, people think inflation is going to be high for a long time. They're going to say, hey, Mr. Employer, you got to give me a bigger pay increase because inflation is going to be high. And the businessman says, if he thinks or she thinks inflation is going to be high, they'll say, fine, no problem. I'll give you the bigger pay increase, and then I'll pass along the higher price increase to consumers. And then lo and behold, people's expectations, their views of the future inflation actually results in higher inflation. That's the problem.
A wage raise means a corresponding rise in prices, unless productivity is increased proportionately.
What do you want, a guy with 4 arms?
But even people within the Fed think these models are broken. In September 2021, a senior economist at the Board of Governors published a paper. It was titled, "Why Do We Think That Inflation Expectations Matter for Inflation?"
That's definitely a non-consensus view.
The paper argues that the field of mainstream economics provides cover for a, quote, criminally oppressive, unsustainable, and unjust social order. The paper reflects the views of a wider movement of people who think the Fed needs reform.
There was an internal debate inside the Fed in 2008, in 2009, in 2010. Why did we miss the financial crisis? Why did we miss the subprime crisis? And it was determined at the time that the Fed's inflation model really was broken. Because had it incorporated securities prices, had it properly incorporated the price of housing, residential real estate, then the Fed wouldn't have been blindsided ahead of the financial crisis. So what they did after writing all these internal white papers and determining that they needed a new inflation regime was nothing. And because they needed this broken model to hide behind, which systematically understates inflation so that they could keep easier monetary policy than they would otherwise to prop up the stock market.
Many people who watch the Fed cite breakdowns in models like the Phillips curve. The Phillips curve is a model that economists use to make interest rate decisions. The model contains two inputs: inflation rates and employment data. Various forces shift where the economy is along the curve at any point. When the employment indicators point to a tight labor market, the plot of the Phillips curve shifts to the left. That means that there are more jobs open than there are workers to fill the roles. That also increases the pressure on employers to raise wages, which means higher rates of inflation. The Fed can control inflation when it's coming from the labor market.
Their main tool for doing that is the federal funds rate. And by lowering that rate, it tends to help to spur economic growth and job creation. And when they raise that rate, it tends to slow that growth and the resulting job creation. The reason for doing that would be if there were concerns about inflation growing too fast or potentially getting out of control because the unemployment rate is too low and starting to put upward pressure on prices because there is upward pressure on wages.
Some economists believe that in 2019, the official models produced an error. That year, unemployment dropped to 3.5%. When unemployment gets this low, the Phillips curve tells us that prices should start to rise. The Fed started to hike interest rates before sending them back down in the pandemic.
I think one of the things that we have learned coming out of that recession and more recently is that the economy has probably been further from what would be a genuine level of full employment.
Some say that the failure to lift off interest rates is a mistake that the country will have to pay for in the future.
Jay Powell in 2018, 2019 found out that he couldn't raise interest rates. So he failed to get interest rates to his own personal stated target of 3%. He never got to. When you have a Federal Reserve that one cycle after another, they try to resolve an underlying issue of over-indebtedness, whether it was the household sector before the financial crisis or the corporate sector before COVID hit. Every time they have a crisis hit, they try and solve the problem of over-indebtedness by putting more debt into the economy.
Others still believe that the country is in an extraordinary time that calls for emergency measures.
The current environment that we find ourselves in is extremely unusual. All of that really is affecting inflation in a way that we wouldn't typically see during the normal course of how the economy functions.
In recent decades, outside forces changed labor in fundamental ways.
When unions were a force to be reckoned with, and when employees had the upper hand, then there was a very tight relationship between inflation and wage inflation. So you could have this spiral of rising wages. When we started to de-unionize the country, when employers started to outsource to India and other countries and started exporting deflation because its labor was so much cheaper, all of these elements ended up giving employers the upper hand over employees in America. So the efficacy of the Phillips curve started to become kind of outmoded. And there wasn't this immediate feedback effect from rising prices into rising wages.
Policy decisions informed by models like the Phillips curve have had a real impact on American workers.
The wages and benefits of a typical worker were suppressed in the period 4 decades after 1979. Why is that? Well, it's not because the economy was doing poorly or because of automation or because of low productivity growth. In fact, it was because of policies which generated a situation where wages were suppressed. Excessive unemployment because of failed macroeconomic policy, monetary and fiscal policy, to the bashing of unions, the decline in union membership, the failure to increase the minimum wage along with inflation, various new policies of corporations forcing people to sign non-competes and forced arbitration agreements.
As a result, leaders are making adjustments to prepare for the new normal.
Longer-term inflation expectations, which we have long seen as an important driver of actual inflation, and global disinflationary pressures may have been holding down inflation more than was generally anticipated.
President Biden nominated Powell for a second term, hoping that would help the Fed maintain its independence.
I'm nominating Jerome Powell.
That will be important as the group embarks on a new and unusual decade.
So I think the strategy the Fed is now pursuing, and it's a stated strategy, is to try to keep the job market really tight, really strong, for an extended period. And that means then you'll see stronger wage gains across all income groups, but particularly low wage groups. But it's a tricky thing and, very difficult to pull off.
The Fed has kept interest rates near zero for more than a decade, and the outlook suggests that it will keep rates low for the foreseeable future. That's because the United States and countries around the world have failed to hit their inflation targets in recent years.
The Fed itself was incapable before of creating inflation. It was, quote unquote, pushing on a string. So it said, we're going to allow inflation to run hot going forward so that we can try and balance out all of these years of not being able to produce the inflation that we said we wanted to target, of being underneath that 2% target for so many years.
In other words, if the temporary bottlenecks caused by the pandemic and its supply chain disruptions fade, we'll need to keep interest rates low to keep the economy afloat. Some say the Fed may be better off pursuing a higher long-term inflation target, possibly of 3%. That can fight the expectations of sluggish future growth.
I think that deflationary forces will continue to be a force, especially up the income ladder. Now that you can put an entire law library into a little chip of big data, you don't need a paralegal in the United States. You can get a paralegal in India. So higher income paying jobs right now are the ones that are at risk of being sent over shores. And nobody's talking about that. You're actually going to have inflation in terms of the amount of education you need in America. You're going to need that graduate degree to have the pure certainty of income security going forward, because you're going to need that next skills level up, because a lot of jobs that require a bachelor's degree are going to go away. So that disinflationary impulse is going to be there.
But in the short term, the Fed and the entire country will wait to see if these price spikes calm.
There's no obvious direct way the Fed can help. Really, the onus, I think, is on Congress and administration. Lawmakers do have the tools, the ability.
I don't think that the American Rescue Plan created this crisis, or that the Fed's monetary policy has created the inflation problem. Their ability to change the interest rate would do something. It would slow the pace of the recovery.
Central banks around the world have injected money into the economy at a record pace to try to fight a global recession triggered by the coronavirus pandemic.
Just getting word from the Federal Reserve.
Bombshell announcement from the Federal Reserve.
It is an absolutely historic week, both in terms of the speed of Fed purchases and, of course, the magnitude.
Since mid-March, the Federal Reserve's balance sheet has ballooned from $4 trillion to around $7 trillion, equal to about 1/3 of the value of the entire American economy.
A new CNBC survey showing that market participants expecting trillions more in stimulus from both the central bank and Congress.
At the same time, governments have enacted record amounts of fiscal stimulus to boost economies stalled by the pandemic. The infusion of cash into the financial system has renewed concerns that inflation could surge.
As Milton Friedman said, inflation is always and everywhere a monetary phenomenon. If you believe that, you look at the central bank balance sheets exploding right now, and you say, there's going to be inflation.
Supply shocks have driven up prices for some goods over the past few months. Yet recent history suggests inflation is more likely to stay low for a long time, as unemployment remains near record high levels and consumer spending is subdued.
While there certainly is quite a lot of disruption to the supply side of the economy, that's likely to be dominated by the huge hit to aggregate demand.
So how will trillions of dollars of economic stimulus affect the outlook for inflation? Inflation refers to an increase in the prices of goods or services over time. One well-known measure of inflation in the U.S. is called the Consumer Price Index, or CPI.
The CPI is about the prices that we pay for services and goods and housing and rent.
Economists say some inflation is healthy for the economy. When the economy is growing, more consumers and businesses are outspending money on goods and services. This increase in demand results in higher prices. Demand is an important factor in the outlook for inflation. Generally, when unemployment is high and consumer demand is weak, inflation is low. Another factor that affects inflation is commodity prices. If oil prices rise because there's a cut in production, gas prices might increase too. Consumer and business expectations about prices are another piece of the inflation puzzle. If a lot of people expect prices will rise in the future, they might spend more now, ultimately causing inflation.
The level of actual inflation that we get will be pretty heavily influenced by the inflation rate that actors in the economy, so households, businesses, consumers, workers, investors, expect to prevail.
Like many other central banks around the world, the Fed targets a 2% yearly inflation rate. At that rate, a cup of coffee that costs $2 this year would cost $2.04 next year. Not quite enough to break the bank. Central banks adjust their policies, normally by changing interest rates, to try to get to that 2% inflation level.
You definitely want to keep enough inflation so you can still have enough space to raise and lower Fed funds over the business cycle.
Too much inflation isn't a good thing either. As inflation rises, the money that you hold today becomes less valuable tomorrow. At a 15% inflation rate, for example, your $2 cup of coffee today costs $2.30 next year. Think of how that would affect a bigger purchase like a car. A $10,000 purchase today would cost $11,500 next year.
When the inflation rate is very high, it's very difficult to make any calculation about saving.
Inflation concerns for now are to the downside. The risks are to the downside, not to the upside. We see prices moving down. That's because in a lot of parts of the economy, people are cutting prices.
Lockdowns have already depressed prices in the U.S. as consumers stay home and remain cautious about spending money in an uncertain economy.
The second biggest drop in headline inflation since 1947.
Energy commodities down 20% with a 20% decline in gasoline. Fuel oil down 15%.
There have been pockets of inflation in some areas like groceries, as more people cook at home. Disruptions in global trade from the virus have also raised prices for goods like medical supplies. Still, these supply shocks haven't offset overall weak demand.
If you're in the average person's seat, we're talking about, grocery stores and that sort of thing. The idea that there's going to be an outbreak of inflation, 4%, 5%, that is just not on the horizon.
Many economists and policymakers expect wages will stay low as unemployment remains high. Meanwhile, people are saving instead of spending their cash out of fear the economy could get worse. To try to boost the economy, policymakers in Washington have pumped trillions of dollars into the financial system in recent months. Economic theory suggests all this money printing could create the risk of inflation. Economist Milton Friedman famously said that if there's too much money in the economy chasing too few goods, prices will rise. When inflation was surging in the 1980s, Fed Chairman Paul Volcker put Friedman's theory to the test, and it worked. Volcker slowed the growth of money going into the economy and raised interest rates to tame inflation. But economists say there's been a break in the link between money creation and inflation in recent years as the banking system has become more complex.
The rise of the financial system and the sort of the diversification of the financial system is one of the reasons why sort of the Milton Friedman view of the world really is not as applicable, particularly in the United States, as it was in an earlier time.
It's important to understand that when the central bank prints money today, most of it isn't in the form of physical dollar bills. Instead, the Fed creates electronic money. It uses that electronic cash to buy assets and lend to banks, injecting money into the banking system. To buy treasuries, for example, the Fed uses so-called primary dealers, a group of around 24 big banks and brokerage firms that trade bonds.
What happens when the Fed creates money is it strictly creates central bank money called reserves. Those are held by the banking system. Now the banks decide, what they're willing to lend out into the economy.
That means that even if the Fed is pumping a lot of money into banks like it is today, the money won't reach the hands of consumers until banks lend it out. It is true that money has been handed out directly to citizens as part of the federal government's coronavirus response, like the $1,200 stimulus checks. This cash infusion still might not result in inflation. Most Americans needed the checks to make day-to-day payments to make up for lost income during the crisis, not to go out and spend lavishly on other purchases.
I think of them as more life preservers, trying to prevent the economy from getting into a deeper hole because of the COVID crisis. And they don't represent stimulus yet.
Recent history suggests that all the fiscal and monetary stimulus during the pandemic is unlikely to increase prices for consumers. When the Fed bought trillions of dollars of assets after the 2008 financial crisis, inflation never surged.
After the Great Recession, there was a conviction that all the fiscal and monetary stimuli were going to result in huge inflation. As a matter of fact, a number of investors, including some very famous hedge funds, went to gold. Well, what happened? Big deficits, but inflation has come down.
The experience of the last decade is that central bank balance sheet expansion certainly need not generate a period of excess inflation. And in fact, even with a big balance sheet, it might still be hard to get the inflation that you want.
There are limits to what history can teach us when it comes to understanding the economic situation right now. Even if the economic stimulus doesn't result in higher prices for consumers, many say that inflation is showing up in the prices of other assets, like the stock market or the housing market.
One of the most interesting questions that we have right now is the difference between the price inflation that you and I see at the grocery store or at the gas pump or when we're buying something. That's one measure of inflation. But another measure of inflation that is also very important is asset price inflation. In other words, what's happening to the stock market and what's happening to, credit spreads. I think we're looking at very significant increases in asset price inflation.
Inflation expectations are another risk.
If people start thinking, the money supply is increasing, inflation is going to be high, when expected inflation becomes high, then you start asking for increases in wages and prices, and these expectations become what we call self-fulfilling.
In the long term, factors like globalization, technology, and aging populations all play a role in consumer prices. A weaker U.S. dollar or backlash against global supply chains, which have been disrupted during the pandemic, could create inflation risks.
If you were to seal the borders and literally cut off any imports and then embark on this huge monetary and fiscal stimuli, they could create inflation.
There's one more big risk to inflation, and it comes with 9 zeros attached: record high public debt. Trillions of dollars in economic stimulus during the pandemic have increased government debt at a rapid pace. In recent years, some economists have argued in favor of deficit spending to fund public investment, though many debate what effect this could have on inflation. Because government debts are set in fixed dollar amounts, higher inflation makes it easier to pay off those debts. Some worry that politicians might put pressure on central banks to chase higher inflation to help finance the growing national debt.
We need not worry too much about the size of the Fed's balance sheet. What we need to be focused on is whether the Fed will, at the appropriate moment, have both the judgment and the institutional independence to raise interest rates, even if that might conflict with some other interests, for instance, the interest of the government of the day.